Hello investors, welcome to Simpli Stocks. The June first quarter is progressing quite well. The companies from our watch list are delivering quite good results back to back, and they are also making new highs at the same time. So today in the second video of our Q1FY27 Results Series, I have brought 4 trending small cap businesses for all of you that are currently doing quite well. Today's video will be very interesting because 2 out of these 4 businesses are newly listed. So I'll be covering them for you for the first time because I see quite good potential in both of them from here. And then as for the other 2 stocks, they are also going through a turnaround. They remained ignored for a long time, but interesting triggers are playing out in them right now that will keep them in focus for the next 1.5 to 2 years. So today's video is going to be very special. Now, without any delay, let's quickly get started. The very first business that we will study today is Bajaj Consumer Care. I have been covering this for some time in our Simply Stocks community, and after the last quarter's results, I covered this business for you on our YouTube channel as well. Since then, it has done quite well, and the results have also been good too. So let us start with them only. Bajaj Consumer is in the hair oils business. You might have heard of Bajaj Almond Drops hair oil. That famous brand belongs to them. Apart from this, they also have a portfolio of coconut and other hair oils, which is growing fast. Bajaj Consumer is currently doing quite well under its new management. They have taken initiatives around raising prices, expanding distribution, sales management, and also mix improvement, or basically they are focusing on slightly higher margin hair oils. Now coming straight to their results, so you will see that in Q1, that is in the months from April to June, their sales stood at 341 crore rupees, which is a 28% growth over last year. Their EBITDA has doubled compared to the last year. There has been good margin expansion. Year on year, margin has gone up from 15.8% to 24.7%. There is also improvement on a quarter-on-quarter basis as well. So this margin expansion is what makes this business so interesting. Now, if we look at net profit, there was a tremendous growth of 85% there too, and net profit margin has also increased to 21%. However, on the other hand, what has happened is that due to the war, there has been pressure on the gross margin. What happens is basically oils contain LLP or light liquid paraffin, and this is made from crude oil in a way. So due to the war, its price has gone up. The war was de-escalating a little bit, then it started again, now it is de-escalating again. So all in all, that is going on, but there will be pressure on margins going forward too because of all this uncertainty. But despite that, I'll say margins have remained strong. They have made price revisions. So overall, I'll say performance has been good for Bajaj Consumer. Apart from this, what usually used to happen was that prices of other oils like mustard oil and almond oil, so they would cool down. But this time, those are also elevated. So yes, although the price of coconut oil, coconut has cooled down a little bit. So because of that, there were good volumes in coconut oils. But yes, other oils, they have seen inflation. And now what's there is that in ADHO, we have seen low teens growth, that is about 12 to 13% volume growth. Now, this might seem low to you, but this is after accounting for ml reduction. So they have reduced the quantity in terms of ml in their bottles and sachets to improve the margins. And besides this, the small packs and sachets that they had launched, so they have brought very good growth. So overall, there is very good growth in almond drops. And to counter this inflation in raw material prices, they have also slightly increased their average selling price. Although they have been raising selling prices throughout the year, but broadly, if we compare, the average selling price has grown by 29% compared to the last year. But from here on, the management says that there won't be any further price increases. Looking at the raw material, yes, they might adjust prices slightly, but yes, on an overall portfolio basis, the price increases and changes they had to make, they have largely done that. Like earlier, they used to give deep discounts in coconut oils compared to Marico. Now that pricing has also become competitive. So there won't be any significant increase there either. From here, what management says is that margin expansion that takes or that happens will come from operating leverage and not from raising prices. Besides this, their growth portfolio has done well. So that is about it. That includes non-ADHO brands, in that there has been a 7 to 9% quarter-on-quarter growth. If we look at it on annualized basis, it is about 30 to 40% growth. In non-ADHO, management is quite focused on the Banjara brand. So they had acquired this brand some time back, and now they are very involved in growing it. So all in all, these are I'll say good set of numbers. And an interesting thing that happened is that while last quarter was good anyway, in this quarter, that is in Q1, overall growth has also accelerated a little bit. So this was not expected actually. And the reason for this is the same thing I was telling you, that small packs and sachets, so they have performed well for Bajaj consumer. That is why we can expect good numbers here, good numbers from here for the next 2 to 3 quarters. And the management is also very confident about growth. They say that they can comfortably bring double digit to about low teens, or approx 10 to 15% volume growth. Apart from this, their guidance is that EBITDA margin should sustain in the 20 to 25% band, and they plan to grow their non-almond drops hair oil portfolio at a CAGR of 30% to double it, and for their core categories, they are targeting about 10% growth. So overall, this is quite healthy growth in the FMCG space. Although one thing you must keep in mind is that yes, right now the management has made so many good changes so far, and the business has done well. So that is there. So the growth will remain high for the next 1.5 years. But gradually a slowdown will come in this business. So if you are interested in Bajaj Consumer, I personally feel that the best time for them will be this next 1.5 to 2 years from now. So although it has rallied recently, but after the Q1 results, but it is still at a PE of roughly 30 to 32. So if we compare it to other FMCG players, it is still undervalued. However, what will happen is that as this business grows going forward, a slight slowdown is bound to come. So the base will keep getting larger and larger. But yes, overall, I see quite good visibility here for the next 1.5 to 2 years. Apart from that, the only risk I see is the main risk of raw materials. The price of liquid paraffin has gone up due to the war. But overall, this is a good business. Margins continue to be stable despite volatility. So you can look into this. Moving forward, today's second business, which has reported quite good results, is iFinance. Now, iFinance is basically from microfinance or MFI space. But within MFI, it operates in a niche and unique category, which makes it a bit special among other MFI businesses. Let us understand a bit deeper so that we'll get to know what it actually does. So iFinance gives loans to very small MSMEs whose annual sales are between 30 lakh to 1 crore rupees. For example, let us say if there is a small shoe shop or a dairy, or if someone has an electrical works or electronics repairing shop, or let us say like a small steel fabrication industry where gates, railings and all they are made. So they cater to such businesses. Whereas other MFI players like Arman or Credit Access, they give loans to individuals or self-help groups. I targets specifically micro SMEs, and this is a niche under-penetrated segment, or we can say there are not that many players over here. Like across the country, you will also agree that there are so many micro MSMEs that require credit, but there is no one to serve them, right? And iFinance speciality is that these small businesses mostly run on cash-based transactions. Like they are not registered and they don't do GST filing and all either. So iFinance has its own proprietary risk assessment models in which by looking at cash transactions and various other things, they do credit underwriting accordingly. And then they give loans to these businesses, or let us say the unorganized micro MSMEs. Now they have about 571 branches and they have a base of about 6.7 lakh customers. Here, 51% of their loan book is of trading businesses. Then comes livestock rearing segment, which includes your dairies, poultries, etc. It has a 25% share in the AUM. And most of their presence is in markets like Bihar, Uttar Pradesh, Rajasthan. Now this year, they will mainly focus on growing their existing branches, stabilizing them and growing their AUM over there. Then they will also be adding just 40 to 50 new branches. The main branch expansion iFinance is targeting, that is planned after Q3 or Q4. Now moving forward, talking about the loan book, 77% of their loan book consists of hypothecation loans. These includes assets that the business or individual is actually using right now, and against which they have also taken a loan. Like take pickup truck as an example. And apart from this, they also give loans against land and houses, basically your mortgage and loans against property. So I have given you a fairly good idea of the business model, what actually iFinance does and what is their specialty. Now let us directly look at the financial metrics. So here you will see that AUM, or total loans that they have given, they have grown by 28% over the last year to more than 7,300 crore rupees. Disbursements or new loans have grown by 22% over last year. Then here you will see that their net interest income, there has been very good growth over here. It is up 28% over last year to cross the 332 crore rupees mark. Although here you will see that there is a slight difference between gross income growth and also net income growth. The reason for this is that last year there was a bit of forex movement, and also there was some portion of DA. What happens is that in DA, NBFCs directly transfer their loans to banks. So last year that income was higher. That is why the gross total income base was larger due to last year's other income. So the growth looks slightly lower. So that explains the difference. Nevertheless, I will say these are pretty good numbers. Now see, last year the microfinance sector itself was down. NPS went up, so credit cost was high. But this year there has been a very good recovery across all the stocks you will see. So credit costs have come down. In Q1 last year, credit cost was 5.35%. This year it has come down to 4%. So because of this, you will see that net profit has grown so well. There is a growth of 144%, mind you, in the net profit. So that is there. Now moving forward, here you will see that yield, or basically the average interest rate I gives on which I gives loans. So the interest yield is 22.4%. In this, their net interest margin stands at 15.9%. And here you will see, while NIM is expanding anyway, the cost to income ratio has also come down. Or we can simply say that iFinance is getting the benefit of the operating leverage. Like, it is not written here, but their AUM to OPEX ratio is 9%, which management has said that from here, as the business grows, they will keep getting more operating leverage and it will come down to 7.5% in the next 3 years. So going forward as well, we will continue to see margins expanding in this business, and I will continue getting operating leverage. And apart from that, you will see that asset quality has remained stable. On this, management says that this year asset quality is going to see sharp improvements because the entire sector now has recovered. And here you will also see that the PAR numbers, so they have also improved. So all in all, good progress on asset quality front as well. Another positive development that happened in iFinance is that their credit rating has also seen improvement recently. Because of this, what will happen is that their borrowing cost will decrease going forward. So that will also help to expand NIM by 10 to 15 basis points. But at the same time, their management has told that contribution of mortgage loans in the business is going to go up. So with mortgage loans increasing, there might be a slight pressure on yields because mortgage loans are secured loans. So the yield on them is lower. But what will happen is that low borrowing costs on this side, so they will help to counter this to a large extent. And what was I telling you earlier is that their asset quality has remained good. This here you will see that collection efficiency, PAR numbers, credit cost, there is improvement everywhere. And besides this, what happened was that their IPO came out a short while ago. So since then, the company has sufficient capital. From here, they can easily grow their loan book up to 14,000 crore rupees by increasing leverage. So thus, I will not have to raise more capital in the next 2.5 years because they are sufficiently, or let us say adequately funded, and they can increase the leverage. Now, see, as I was telling you, the last 2 years were challenging for microfinance space. Despite this, iFinance has delivered a ROA of 3.1%. Now, as credit costs normalize and the business gets operating leverage, so they can easily achieve 4 to 5% ROA over the next 3 years. As for the credit cost, their guidance is about 3.5%, which is fine for their segment. Apart from this, they have also given guidance to keep growing AUM at 25 to 30% CAGR. So iFinance is a good business that you can study on your own once sector is coming out of recovery, and their business model is also quite good, quite attractive. Plus, the valuation right now is also quite attractive here. I is currently trading at a PB ratio of 1.6. So it is a good valuation, good stock. You can look into it. Now, see, I or Bajaj Consumer both are doing well right now, but there is no guarantee that they will remain good going forward as well. Because when you invest in small caps or micro caps, buy and hold or buy and forget, such strategies don't work here. You have to keep checking quarter on quarter whether the reason for which you invested, that story is playing out or not. You have to keep tracking results. You have to keep listening to the con calls. So you are seeing right now, first you have to shortlist good businesses from different sectors. Then once you find a good stock, you also have to constantly monitor it, like when to invest more or when to take an exit. Because in small caps, what happens is when things go bad, they go bad very quickly. But for a retail investor, it is not possible to spend so much time in picking good businesses out of so many stocks. And then you also have to study them deeply. You also have to track them deeply. So that is why we have created a personal WhatsApp community for serious investors where we closely track almost 100 good businesses for you. This is across the whole market universe, from large cap, mid caps to many small caps and micro cap businesses as well. I discuss everything in detail, their business model, valuation, risk factors, how are their results, and so on. Here, I also share my personal portfolio and I clear all your doubts on a one-to-one basis. But remember, this is a paid community and there are two plans in this: 6,000 rupees for 6 months and 10,000 rupees for full year. In the 6-month plan, your monthly cost will average to just 1,000 rupees, and in the full year plan, your monthly rate will be just 850 rupees. So if you are interested, send a WhatsApp message on this number, or else you can also contact us and join this community through the link in the description below. Coming back to our discussion, today's third business that has reported standout numbers is Ujjivan Small Finance Bank. Because of its results, the stock has also trended quite a lot recently. Ujjivan's net profit has tripled compared to the last year. Now, I think going into the details of their business model is not really necessary as such. It is like a regular bank only. So we will focus on the results. Let us directly look at their Q1 results then. Here, you will see that now in the months from April to June, their deposits grew by 25% over last year, and a very good growth was seen in loan book as well, about 29% growth in loan book. Ujjivan is now focusing more on secured loans. Like if you look segment wise, a fantastic 249% growth came in gold loans, followed by 101% in both agri banking and micro mortgages. Then 85% growth came in vehicle loans and 54% in MSME lending, and a good 33% growth was seen in affordable housing. Their disbursements also grew in a similar way. Disbursements increased by 41% year on year. The growth we see in segment-wise AUM almost overlaps here too, to a large extent as well. But yes, you will see that there is not very much momentum in MFI loans yet, which is why I was telling you that Ujjivan is focusing more on its secured loan book. That is what they are focusing to grow. And you will see the difference between these loans right here. Like on MFI loans, they are able to charge an interest rate of 22.5%. Whereas on the other products, the average yield is about 12.3%. MFI loans are also very small in size, about 60 to 70,000 rupees in size. And here margins are high. But at the same time, what is there is that the risk that is also higher, because these are essentially your unsecured loans. That is why the bank is gradually increasing customer of larger ticket side secured loans instead of just growing the loan book randomly. So Ujjivan is also focused there on higher value secured products. So that will make the business more diversified and also more stable in the long term. Now, talking about the asset quality, performance has been quite strong here as well. Asset quality has consistently improved over the last few quarters. Gross NPAs have dropped from 2.5% to 2.2%, and SMA, or those accounts that are slightly delayed, there is improvement there as well. And along with that, PAR 0 has also improved from 4.8% to 3.6%. Now, like Ujjivan is also a major beneficiary of MFI recovery. last year they had to take a significant hit as well. But now that the sector is back on track, credit costs for Ujjivan, so they have also declined, and hence a very good growth has automatically come in their net profit. We will be talking about this more ahead. Another positive thing is that they have been continuously increasing their provision coverage ratio. As a result, Ujjivan is better protected than before. Firstly, the contribution from secured loans is increasing. Secondly, PCR has also increased. Apart from this, they have also floating provisions in place which can help to absorb future stress if the need arises. So all in all, this is a very good improvement across all metrics. The balance sheet for Ujjivan has also improved. So there is very, very good progress. Now coming straight to the financials, here you will see that interest income grew by 25% and total income increased 22% over last year to reach 2,280 crore rupees approx. Pre-provision operating profit, that is PPOP, grew by 52%. And what I said is happening across all MFI companies. And here you will notice also that if we look at credit cost, it has dropped from 225 crore last year to now 127 crore rupees. Or basically, they had to make fewer provisions for bad loans. As a result, their net profit tripled, and you can see that very good, tremendous growth of 207% has come in the net profit. Now, as for the future, for this year, their management has maintained their guidance of 25% loan book growth. Plus point is that due to such a good performance in Q1, management has raised the ROA guidance as well to 1.8 to 2%. Apart from this, collections in the microfinance portfolio have also become quite stable. Because of this, credit cost should remain lower compared to before, and we will see very good profit growth across the whole year. Now, many times here I want to talk about this. Now, many times people ask me whether Ujjivan is good or Utkarsh or Arman are better. So my view on this is that I do not look at Ujjivan as a microfinance lender anymore. Ujjivan is on the path to become a universal bank. A short while ago, they had even filed their application, which was rejected by RBI because their loan book is not as diversified. But you will see that they have been putting a lot of emphasis on secured loans. Their secured book has grown from 45% to 50% plus in 1 year, and the target is to take it up to 56% by the end of this year. So Ujjivan is a good emerging bank that you can study, not as a microfinance lender. So let us move forward now, and let us finally look at our fourth and final business of today, which is Bluestone Jewellery. So they have also reported standout numbers in June quarter. This quarter has been good for company in terms of margins as well, along with the top line growth. So good margin expansion was also seen, and along with that, they have also given very strong guidance for the future as well. So that is why we are studying this business today. Now see, although I have been covering several jewelry businesses on our channel that have done quite well, like Sky Gold, Kalyan Jewelers, and so on, I now feel that Bluestone is also an emerging, interesting business in the jewelry space that you should track. But let us understand their business model once, then we will get to the results. Because they are a bit different from other jewelers like Tanishq or Kalyan. They are focused a bit more on heavyweight or bridal jewelry. But Bluestone specifically sells lightweight daily wear or occasion wear jewelry in the range below 50,000, 75,000 rupees. Here, your margins are also high because the making charge is higher over here. At this price point, the focus for consumers, it is more on designs. So that is why the share of studded jewelry for Bluestone, that is also higher compared to the industry. And along with that, different kinds of precious metals are also used, like silver, platinum, etc. So that also keeps margin high. And another added benefit is here that your repeat customer is also high, about 60%. And this segment of jewelry below 1 lakh rupees or 75,000 rupees, that is growing quite fast in India. So this segment itself is growing annually at a CAGR of 18 to 20%. Demand for bridal or heavyweight jewelry is no longer growing that fast, but this segment is quite attractive. Now here, Bluestone follows an omni-channel approach. They have 352 stores across the country, and apart from that, they also sell products through their own website and app. They also have other advantages, like they are very vertically integrated business. Both technologically and manufacturing wise. Let us understand this also for a moment. As we see in the case of other jewelers, 50 to 60% of their business comes from own manufacturing. The rest they outsource to B2B contract manufacturers. Let us say like Sky Gold or about Shanti Gold. On the other hand, Bluestone is much more design focused. They have always been focused for their designs. So they manufacture all their jewelry pieces in-house. Around 95% of their sales come from in-house manufacturing. And apart from this, their website and app, so the entire tech infrastructure also, so that has also been developed completely in-house by themselves. And this in-house manufacturing helps them in two ways. Firstly, they get benefit of 4 to 5% margin, which let us say any jeweler has to pass on to manufacturer. Let us suppose if Kalyan gets jewelry made from Sky Gold, they would also have to pay a making charge to Sky Gold, right? So firstly, they are able to save that margin, which a retailer pays to manufacturer. And secondly, they have a lot of control over their designs. Otherwise, what happens is many times the designs of manufacturers get passed on, sorry, the designs of, manufacturers get passed on to other players in the market as well. So that design essentially becomes commoditized. But here, Bluestone has this advantage. And as I told you, in this category below 50,000, 75,000 rupees, this provides them a moat, because the purchases here in this category are design-led purchases. Or let us say the customer doesn't buy their product from an investment perspective or by looking at the grammage. Instead, they make a decision on the basis of the design. So with this, all the business description I gave to you about Bluestone, let us come straight to their results. So here you will see that their sales, they have grown by 49%, mind you, compared to the last year. Contribution margin has remained stable. Contribution margin is basically what remains after basic expenses like making cost, packaging cost, that has been incurred. So after all these expenses, you get contribution margin. Apart from this, you will see very good growth in reported EBITDA. The reported EBITDA margin has reached 15%, but it will be better if we look at the pre-Ind AS EBITDA margin. Here, your inventory gain gets excluded. What happened was that because of the government recently raised the import duty, many jewelers will be recording inventory gains. So the value of the gold basically that they held in stock, that went up. So they made a profit. But if we look at, we have to look excluding that. So here you will see that EBITDA has grown by solid 145% over the last year. But what is even more interesting, or what deserves even more attention here, is that EBITDA margin went up from 4.7% to 7.5%. So there is a very, very good margin expansion also that is happening over here. This is a very good thing. And this business is getting full benefit of operating leverage. Until 2 years ago, Bluestone used to be in losses. They were rapidly opening new stores and getting the platform ready. But we can say whatever investments they have made in the past, they are now bringing results for Bluestone. So this base of 352 stores they have now, it will help to bring very good sales from here on. But your other expenses like salaries, management compensation, and so on, they won't grow that fast. So margins are going to expand rapidly from here. Now see, they did sales of about 2,436 crore rupees in FY26, that is your last year, and the management has given a very, very bullish guidance, mind you, to take their sales in the next 4 years to 12,000 crore rupees, which in terms of CAGR translates to a tremendous growth of about 50%. So that is very, very healthy growth is what they are promising. In this, the management is working with an estimate of 30% SSG and 20% your distribution growth. For SSG, they are saying that on an average, the older stores themselves, so they will keep bringing 30% sales growth annually. And apart from this, 20% growth will be the growth that comes from opening new stores. By the way, 30% SSG might seem high to you, but I think that they will be able to achieve it in the long run, because among other traditional jewelers, the good players anyways manage to bring 10 to 15% SSG. And Bluestone operates in a lower price point, or let us say lower ticket size segment, where growth is even better. So they will be able to do that, because what has happened is that after COVID, the market for daily wear and occasional jewelry in India, that has boomed very rapidly. Earlier, people used to buy heavyweight bridal jewelry more, but now very good growth is coming in this segment as well. Apart from this, what is happening is the trend of fashion jewelry is also growing. People, more these days match their jewelry with their clothes and then they wear it. So lifestyles are also improving and there are changes over there. So all in all, there are very strong tailwinds in this particular segment. And you will see even your traditional jewelers, like let us say Kalyan with Candier and Gadgil with their lifestyle stores. Everyone is trying to have a pie of this market or this segment. And as you are seeing, on top of this 50% CAGR sales growth that Bluestone is targeting, there is also room for margin expansion as well. So that is also a very big trigger in itself. Their guidance is that the margin, which is about 7.5% right now, it can double from here. So if you ask me, I look at it this way, that even if it doesn't happen in 4 years, let us say it takes 5 years instead, even then, along with such good sales growth, margin expansion makes a very good opportunity over here. So all in all, even though Bluestone has rallied quite a lot after its results, it is still a very attractive business. I would say whatever rally we saw, it was mainly smart money that came in just after seeing the results and hearing to the con call. From here, as we see management executing on these plans, so further value can be created over here. So there is a lot of scope in this business going forward as well. And I think you should study it eventually individually on your own. With this, I'll conclude today's session. But see, earning season has just started now. Companies are bringing out their results at a very fast pace. So if you are new to our channel, please remember to subscribe to Simpli Stocks, because going forward, I'll be bringing many such business analysis for you. And if you like this video, please hit the like button. If you support us with your likes, we will be able to bring more such videos for you on a regular basis. And if you have any doubts regarding all these businesses, feel free to ask them in the comments. With this, I'll see you in the next video. Happy investing.